So now we're going to do our first serious thing for this set of PowerPoints. We're going to discuss Social Security benefits. All right. And what you've been doing so far is calculating the Social Security tax. Now we're going to get old and gray and start collecting. And sometimes you are going to have to pay taxes on your Social Security. Right? You include an income. Got two different sets of calculations coming up. Back in the 1970s, the elderly were probably the largest poverty group. And they organized themselves. You may have heard of the Gray Panthers. They did a lot of politicking. Old people vote, so they get listened to. And so the government made significant increases in Social Security benefits. And then the 1980s came, there was no money to pay the bills. And back then, we had a government that if you could not pay as you go, you simply shut down. All right, and so we had a couple of rather embarrassing situations where the government came to a screeching halt, not dissimilar to what happened last year. And services just are not provided until they get themselves reorganized. And so they wanted to tax something. Politicians never want to raise marginal tax rates. Somehow they're all convinced that if you raise the marginal tax rates, everybody will simply cheat because while they were happy to pay at 15%, they don't want to pay at 17%. And so the goal is always to kind of sneak the income tax in without raising the tax rates. So one potential here was Social Security benefits have never been prior to this taxed, right? It's free income. And there's not that much difference between Social Security and a traditional pension. And in a traditional pension, everything you get back in excess of your own contributions is taxable. So now we need income. We've got a lot of fairly wealthy people collecting Social Security, and we want to tax it. So the first round, up to 50% of your Social Security could be taxed. And so that rule stayed in play for a while. And then we needed money again. And so the decision was to add a second calculation. So when we come to do the math in a minute, you're going to apply this 50% rule. And then if necessary, you're going to apply the 85% rule in addition to. You always want to think of it as a two-step process. The inclusion depends on your tax base. And I've got that in quotes because that's not AGI. It's not taxable income. It is a side calculation that you will do that will determine if you're rich enough to need to include your. All right, so one thing you need to know then to get started is how to define the tax base for this purpose. All right, for this purpose, we include AGI without Social Security and tax-exempt interest, 100% of it. When this rule was being written, the goal was to target rich people so they could pay taxes on their Social Security. Rich people tend to buy muni bonds, and we had a slide about that on the last set because their after-tax return is higher if they don't have to pay taxes. And then we also include 1/2 of Social Security. So remember, 1/2 of the contributions to Social Security are made by the employer, and 1/2 are made out of the employee's pocket with after-tax dollars. So it's only fair to exclude part of the Social Security relating to my share. And so that's our tax base. So I can ask you to calculate the tax base, determine how much Social Security is included in AGI, or I could ask you what is AGI with Social Security considered. So remember, we've got a 50% rule as our first layer. There are two steps. First layer, you include up to 50%, and then your tax base is going to be a function of whether you are single or married. So you can see that the first hit, when I said whether you were wealthy enough, these numbers look like chump change to most of you. But remember that most Americans basically save nothing for retirement. And many Americans would consider themselves ecstatically happy if their tax base was $32,000 when they stopped working. But clearly not targeted just the multimillionaires. That second calculation, the 85% rule, is triggered for single people at 34,000 and for married people at 44. And no, you do not need to memorize these. These will be part of the information that will be pre-printed on the front of all quizzes if they're needed and mini tests. So what we want to do is the concept, right? Not the dollar amounts. And you should note that married filing separate gets no tax basis. So they start paying Social Security from the very beginning. This discourages you separating the income so that, excuse me, the richer person who's still working files all their income, and then the retired person collecting Social Security has a much lower base, and therefore they report less amounts for Social Security. Doesn't work. All right, the next part of the PowerPoints have 4 different examples on how to calculate the taxable portion of your Social Security benefits. I am not going to heavily narrate all 4 examples. I think once I've talked to you about the first one, they're all self-explanatory. Follow the math. If it turns out you have questions, let me know. I'll be more than happy to talk to you about any one of them. There is a worksheet in your Pub 17. Those of you who are very good at reading carefully and following the bouncing ball might prefer to use the worksheet. They should be mathematically equivalent, so it's just a matter of which one helps with your understanding. All right, so we got taxpayer. Need to know whether they are filing single, 2 bases, married filing joint, 2 different bases, married filing separate, no bases at all. So this is the kind of information I'll give you. Some sort of taxable income, right? Bank interest fully taxable. Some information about muni bonds. Any bond with the word state, any state name in front of it. Chesterfield County sewer bonds, VCU build a better building bonds. All of those are muni bonds, and they are not included in adjusted gross income, but they are included in this wealth measure. And then, of course, the person has to be collecting Social Security before Social Security calculations become important. So with that information, I could ask you, what is the modified tax base for determining whether or not they need to pay taxes on their Social Security? I can ask you how much Social Security is taxable, or I could ask you what is adjusted gross income, right? So adjusted gross income is the final answer, please. It would include, from this slide, only the bank interest, and then the amount of the Social Security that is taxable as we work our way through the next couple of slides. So the first job is to calculate the tax base, and you can see it's just exactly what we said, AGI without, tax-exempt interest, and half of Social Security. So this person's modified AGI is a little over 30,000, so the first base will apply. And remember that this modified AGI is not a taxable number. It's not a real thing. It does not show up on the Form 1040. It's just there to do a side calculation. Once we have the modified AGI, we're going to run through the 50% rule and then run separately through the 85% rule if we need to. And our final answer will be the sum of the 50% and the 85% calculations. So here's our first base. Here's our excess, half the excess. Excuse me. Note that half the excess is capped. It can never be larger than, if you're single, the number shown here. For a married couple filing joint, the cap is 6,000. And example 4 does take you through a married filing joint set of filers who have both a 50% and 85% inclusion. You compare 1/2 of the excess to 50% of Social Security, and you pick the smaller number. And here we're done. We do not need the second base because this particular taxpayer's modified base is less than the second base. So we're done. So then we're ready to put it all together and get our final answer for AGI. The bank interest, remember we're leaving at the muni bond interest, and then the amount we calculated for Social Security, the taxable portion. So this particular taxpayer's adjusted gross income is $18,625, and that amount would then be reduced by standard deduction, itemized deductions, whichever's bigger, and an exemption. And then if there's anything left, they would pay taxes on it, starting at their 10% rate, followed by the 15% rate if they actually crossed over to the second tax bracket. All right, the second example, still single, so we know what basis we want to use. This time, all I did was increase the interest on the Virginia bonds so that we have enough income now to trigger the second tax-based calculation. Our goal is still to determine the three items. I can ask you any one of them, so make sure you're reading carefully. The tax base, same basic calculation, all the AGI, all the muni bonds, half the Social Security. And remember that this is not a real number, it's just a side calculation. And then the first base, we subtract the same 25,000, do the same drill, calculate the excess. We cap the excess at 4,500. The 4,250 is still smaller, so we're going to use the 4,250. All right, now we need to use the second base because AGI is over 34,000, which is the second base for single taxpayers. So the excess is 2,250. So we are going to take 85% of the 2,250, add it to our 50% calculation, so that we now have 6,163 as the number we're going to compare to 85% of Social Security. Once again, we take the smaller one. So we have been brought the 4,250 over from the last slide, added 85% of the excess from the new base to get to our potential inclusion, compared that to 85% of Social Security and taken the smaller number. And then, of course, here's AGI again, without Social Security, with the taxable portion. So AGI is now 22,163. For example 3, all I've done is simply make the taxpayer richer. The interest on the Virginia bonds is larger, and the collection of Social Security is also larger. As a general rule, the more you earn while you're working, the larger your Social Security benefits will be. So as I work through the next several slides, if I go too fast, if you want to stop and look at the numbers, all you have to do is end the show and then start it again when you're ready to go. All right, so what we have here is the typical taxpayer who can afford to come and get tax advice. Their income is large enough that for all practical purposes, you could go straight to the 85% rule and take 85% of Social Security and be done with it. And in practice, that's what's generally done when you're advising wealthier elderly taxpayers. You simply assume that 85% of whatever they're going to collect for Social Security will be taxable, and you build that into all tax projections for them. So here is our modified base, the usual suspects. All right, here's our 50% test. 1/2 of the excess is a pretty big number. So we're actually, instead of using the 13,625 to compare to half of Social Security, we're only going to use the 4,500. And so the smaller is $4,500. But ultimately, it's not going to make much difference because on the next slide, we're going to end up having to include 85% of Social Security in our tax base. So here are our second rule, second base for a single person, 34. Our excess is over 18,000, but what we are bringing in is 85% of the excess plus only the 4,500 from the last slide. So that's still a big number, 20,000 and change. 85% of Social Security is smaller, so 85% of Social Security is what we are going to include in adjusted gross income. So this is just a snapshot of what AGI looks like given the facts. Remember, it's AGI without Social Security, the taxable portion of Social Security. That is what I mean when I'm asking you for AGI. Our last example, we are married filing joint, so we have different bases. It really doesn't matter whether it was a non-working spouse or not. All your Social Security, if you're both collecting, simply gets added together and thrown into this pot. And so it doesn't make a difference whether only one of you is collecting or two of you are. The 50% and 85% rules will be done as a single calculation. So lots of income. We're going to go your normal drill. What's the base? How much Social Security is taxable? And what is adjusted gross income? So here is our modified AGI, absolutely the same calculation. whether you are single or married, or for all that purposes, if you're married filing separate. It's just if you're married filing separate, when you get to the next slide, you'd have to put a 0 in for the base. So you wouldn't get any breaks in determining sheltering some of your Social Security from tax. All right, so our modified AGI, and note the first base is higher now because we're married filing joint. Otherwise, the math is exactly the same, except we cap at $6,000 for married filing joint instead of the $4,500. And so we are comparing the $6,000 to 1/2 of Social Security, and we take the smaller of the two. I'm going to take that $6,000 to the next slide and do the 85% calculation. Right, same modified AGI. Our second base is higher for married filing joint. Our excess again, 85% of the excess plus the $6,000 we're covering from the last slide. I'm going to compare that to 85% of AGI. And here the 85% rule is smaller, so we will pay taxes on the excess rule versus the full 85% of Social Security. And once again, here's our final snapshot of adjusted gross income. All right, then we have some items that we'll finish this chapter with, or this part of chapter 4 and 5 PowerPoints. And then for next week, we'll finish up the rest of the material. We're going to talk about interest income. It's got some really strange rules. So if you're a little mind shocked after the Social Security, this is a good time to take a break before you work through the end of the PowerPoints. Dividend income, pretty straightforward. You already did that tax calculation in your first set of PowerPoints. Conduits, you know what a conduit is, a pass-through, right? Tax returns 3 and 4 are them dealing as a partnership or limited liability company or an S corporation. The entity calculates all of the income items, retains the character of all of them, gives you the K1, and then the K1 fits into the various categories on the Form 1040. Pretty straightforward. Capital gains and losses we're not covering until the end of the semester. So interest is either not taxable or it's taxable. Non-taxable are what we refer to as the muni bonds, state and municipal bonds. Tax exempt at the federal level, tax exempt in the state of issue, and sometimes tax exempt by other states too. You have to contact the issuer of the bond to determine whether or not it would be double exempt, exempt from federal and state, in your state if your state was not state of issue. Our next category is obligations of the U.S. government. I'm dealing with them separately because they have rules that are different than muni bonds or normal interest-bearing obligations. First of all, they're fully taxable at the federal level. They're tax exempt at the state level across all states without difference. And then there are some special rules that are in place to encourage people to buy our savings government obligations instead of others. The payroll savings bonds, formerly referred to as E or double E bonds, if you buy them, those are the ones where grandma gives you a bond and it says it's worth $100. And if you immediately took it to the bank, they'd probably give you $56.40 because they're essentially zero coupon bonds. Right? You don't get the face value until maturity. In a minute, we're going to talk about original issue discount, and we're going to learn that for most kinds of interest-bearing obligations, you cannot wait to report the interest. You have to pay it each year. But the government wrote the rules, and it's the government's obligations. So when you buy these savings bonds, you can choose to recognize income each year, or you can defer all interest recognition until redemption. Remember, you're not going to get the cash until you redeem it. And so many people just as soon not pay taxes on money they don't have yet. The important thing is you have to treat all the bonds the same way. And as a cheerful little bouncing baby, you probably got a bond from your grandma and it sat in your mom's drawer and you didn't report a tax return. And so you made the election to report all the interest when you cashed it in. And that could cost you a little bit. If you're rich when you cash it in, your marginal tax rate will be higher and you'll pay more taxes. Educational assistance bonds are also discussed in the book. They allow you, if you buy these savings bonds, if you cash them out, to pay for education of yourself or your dependents, you may not have to pay taxes on the interest income. Really complicated rules. It could show up as a mini test question. And so I would suggest that you look at the examples in the book and try any related homework. Best to be prepared, because on those Thursday nights come 8:30, 9 o'clock, your brain is not going to be excited about seeing material for the very first time. So give it a break. Do some work before you come to class. Okay, now we want to talk about other taxable interests, things that are not muni bonds, which are not taxed at all at the federal level, or federal government obligations, which are fully taxed under their own set of rules. So we're talking about bank interest, corporate bonds, CDs, all those kinds of things. And for the first couple of bullets that we're going to talk here, we're primarily targeting the cash basis taxpayer. If you're an accrual basis taxpayer, you will at the end of every tax year do an accrual like you've been doing as good accountants since your first couple of weeks in Accounting 203. So the general rule is for a cash basis taxpayer, you include the interest as it is paid to you, as long as those payments are going to happen once every 12 months. So I get an interest payment on May 1, the anniversary date of my loan, for every year the loan's outstanding. Then I can wait until May 1 in order to recognize any interest income. Original issue discount relates to zero coupon, zero interest bonds, junk bonds, bonds where I'm not going to get any money until the end. So it's a 5-year note, 5% interest, but I have to wait until the end of year 5 to get any cash. If I was an accrual basis taxpayer, I would simply, every December 31, I would accrue the income that's outstanding. If I am a cash basis taxpayer, I've got to stop and do a tax calculation at the end of every tax year if I'm not guaranteed to pay interest at least once a year. The good news is I'm not going to ask you to do the math for this. You would do the net present value at the beginning of the year, the net present value at the end of the year. The difference would be your interest income. I am not going to expect you to do that. I simply want you to be able to articulate what the tax treatment is if there is a original issue discount. And you'll know it because I will say that you have lent out money and all the cash comes back at the end of year 2, year 5, year 10. That's your signal that you will need to accrue interest even if you are a cash basis taxpayer. Our last category is a little funny. Imputing interest. If you choose to lend money on an interest-free basis, you charge a 0 rate of interest. There's probably a reason why you're doing that, right? I mean, you would not lend the bank interest money and charge them a 0 rate of interest. So you probably have something else going on if you choose to walk away from the interest income. So I lent you money. I'm charging you a 0 interest rate. I'm going to include interest in my income, even though I am never going to get that money. And we've got a bunch of slides talking about that coming up. But first, let's look at an example of original issue discount, talk about it just a little bit more.